Hey, welcome back, traders. It's time for a general market update. It's January the 5th, 2024, a new year. So again, as a reminder, I'm with Rain King LLC, and I'm an amateur individual growth stock investor. So happy new year to everybody. We're going to start off with a clean slate. No matter what you did last year, whether you lost money or you made a lot of money, we all start fresh in 2024. So it's always a good thing. We're going to talk a little bit about the Santa Claus rally, what its status is, we'll go over market breadth. Then we'll talk a little bit about January rotations. And then we'll get back to looking at a volatile week. We had a sharp pullback this week. And what does the action of the leaders tell us? And then we'll wrap up. Okay, so let's get into the Santa Claus rally. As a reminder, the Santa Claus rally is the last 5 days, trading days of December and the first 2 days of January. So this year we had, 4 trading days that were green, and then we had the first couple days of January where we had that sharp pullback. Overall, it was negative. Last year we were positive, as you can see. So it was negative this year. So what does that really mean when the Santa Claus rally is negative? Well, here's a situation where there's the instances when Santa did not show up. And you can see here that the Santa Claus rally, the last one that was negative was actually 2015. And you can see that the month of January also was down. Really, the full quarter returns are very, very mixed, as well as the calendar year was mixed. So not too much to make of it. It's just something to be aware of. We also have what we call the January 1st 5-day indicator, which looks at the first 5 closing days. Last year it was positive. So far this year, the first 3 days were negative. We'll have to see how we close today. And then the January barometer is when the month of January is positive. It's usually a pretty good indicator that the year would be positive. Last year it was. So, Santa Claus did not show up this year in full force, but doesn't mean everything is lost. Now, here's a analysis done by Bespoke. And when January has the first 2 days of the trading year down by at least 0.5%, those first 2 days, there's actually, this is actually the 5th incident of that happening. And you can see what happened next. Well, there's only a very, very small sample size, 1980, 91, 2000, and 2005. But you can see that the rest of January was mixed. Some were up, some were down. And then the year was very, very wide range. You can see 2 of the years were very, very strong. One year was just a little bit in the green, and one was negative. So more of a factoid than anything else. But we'll see how the rest of the month shapes up. Now, putting this into context, we had a very, very strong November and December, our rally. And Carson Research put together, when you do have a strong November, December by at least an S&P gain of 10%. And you can see here's the cases where it happened. What did January do? What did the first quarter do? And the full year? A lot of greening on this table. So even in the context of what we just looked at regarding Santa Claus, a lot of green to look forward to potentially, basically saying that strength towards the end of the year should continue into Q1 and maybe the full year. Now, we know it's an election year. It probably will be a very eventful election year. Again, Carson Research looked at new presidents in an election year. So here we have Joe Biden, elected in 2020, his first year, second year. This year, as we know, is finished positive. And then the election year. Generally, first-term presidents in an election year, it's all green 100% of the time. So if that gives you any consolation, maybe we're going to have an up year. It's a question of how much, but trends can be volatile. Now, I put this slide in here because this was a bar chart of Wall Street's analysts' estimates for the S&P next year. And you can see all the different outfits that put out a projection as low as 4,000 on the S&P and as high as 5,400 on the chart. And I just put, the S&P at the end of the year was roughly around the 4770 level, and a 5% gain and a 10% gain. You can see the levels. Generally speaking, Not too many people are forecasting a strong year. They're saying maybe 0 to 5%. There's a few outliers who are saying maybe we're up in the 8 to 10% range. Um, we don't really want to listen to the news or the pundits. These are the things that these forecasters and news outlets were saying last year. Last October, which was the low in the market, they said that the forecast for a recession was 100%. Morgan Stanley warned about profits would um, tank U.S. stocks, just like in 2008. We both know that this didn't happen. So headlines in the news are not something we want to focus on. Here we are in July, just only 6 months ago. Many Americans fear a recession as severe as 2008. You can see World Bank says it'd be a global economy in recession. It just goes on. And none of these things really happened. Even the banking crisis in the spring, by April 12th, they were saying it's going to tilt us into recession. So my point is, stay away from the headlines, stay away from the news. We want to look at the price action on the charts. So let's dive into market breadth. And I'm only going to show one particular chart. This is the NASDAQ composite on a daily chart. We had this sharp sell-off, and here's the 20 in this purple color. So we've actually had a couple days below the 20, which is not great. So we really need to stabilize here and try to get back up. Otherwise, maybe there's going to be a change in the short-term trend. But what's encouraging is the new highs and new lows, which are plotted on the bottom of this chart. This is actually, as we're pulling back, you can see that the net new highs, we're still net new highs, which is in green. So I like to see that. I particularly like to see it stay above 50. We're slightly below that. I believe this is like 41 or 42, but still a pullback, but the health under the market in the breadth category is still positive, is still encouraging. We'll have to watch it carefully next week to see how things either stabilize or do we get more deterioration. So let's get into January rotations. As we mentioned, at the beginning of a new year, everybody has a fresh new start. Institutional investors and portfolio managers have a fresh start. Fund managers, their performance is getting benchmarked to an index such as the S&P. Now, these institutions spend millions and millions of dollars on research teams and analysts and conferences to try and search out where they should be placing their bets for 2024 and how they're going to get alpha in those portfolios. And this is the time of the year where it can be a lot of cross currents. Could be a lot of positioning, people taking profits from last year, selling in January so they can avoid taxes in 2023, but there's movement to different sectors, different groups. So it's a time of the year we want to really look at group and relative strength the first 2-3 weeks of January. And we're looking for some of these footprints of these institutions, these elephants, volume clues, relative strength, and group and sector strength. So Investors Business Daily, Bill O'Neill had done studies to show that 37% of a stock price movement is directly tied to the industry group. And another 12% is due to the strength of the overall sector. So you can see, roughly half of a stock's move is going to be tied to the sector it's in and the industry group. So that's the reason why we want to start to look for in January where sector and industry group strength is. It's kind of like the Russian dolls. You peel off the sector and you peel off the groups. Then you start looking at individual stocks and hopefully you find a winner. So how do we find winners? I run screens more often in January than I even do throughout the year. So I wanted to just share a couple of screens that I run at the early part of the year, trying to find the leadership. So I've got something called a trifecta screen. I look at the daily stocks up on volume, weekly up on volume, relative strength. So if any of these screens interest you, there's the parameters in MarketSmith. And again, the goal is day to day to run these screens in January because you're trying to get a feel for where the group rotations are and where the leadership is. So this chart is really just showing some of the stronger groups. We had bullish all-time highs in the XLK, which is tech, XLI, which is industrials, XLB, the home builders, and SMH, the semiconductors. They're at all-time highs. That's a really bullish picture. Even though we had a very sharp decline this week and volatile week in some of these, some selling, this is not a sign of weakness yet. If this turns into a completely a breakout failure and we deteriorate, we'll have to reevaluate it. But right now, all-time highs in these sectors is a positive. Now, I also plotted here the recent group performance. You can see in the black oval, you can see these are the groups that were very, very strong in November and December. They ripped higher, and their names you're probably groups you're familiar with: computer security, database, leisure booking, home builders, and even apparel and shoe. Very, very strong. And you can see just in this first week, they've all taken a pretty nasty hit and come down quite hard in some areas. And here in the black line is the actual NASDAQ coming down. So the strong groups have given it back a little bit, but it's really not that much when you consider how big this thrust was from roughly November 1st. Now, here's a chart that I think I saw from Mike Santolo at Cabot Wealth. So I thank him for that. This is the NASDAQ composite divided by the XLP, which is consumer staples. Consumer staples are considered a defensive group. So when the line is heading down like this, that means the NASDAQ is underperforming this defensive consumer staples index. So that's not a good sign. So that's a cautionary sign to say, this really needs to turn around. And I think we're seeing a little encouragement today. This needs to turn around because, the types of stocks and growth investing, we need the NASDAQ and tech and other areas to be strong and outperforming consumer staples, which are really defensive. So we'll have to keep an eye on this one. So let's get into the action of the leading stocks. So I've updated the breakout plot. You can see here, even we had a couple of distribution days, the Friday before New Year's, and then we had distribution day on Tuesday. The last 2 days, the volume backed off a little bit, so they weren't distribution days. There's just 3 of them in the last 10 days. Usually 4 in an 8-day period can be troublesome, but so we'll have to keep an eye on this, and hopefully the distribution subsides a bit. Some more breakouts that have occurred. The best leading stocks come out in the first 12 to 13 weeks. This chart, we're basically showing we're about 9 weeks into this rally. So there's probably some more leadership that might come out in the next few weeks if the rally is going to continue higher. So I always want to look at the leaders carefully on a pullback and see what their action is. And I've mentioned in a previous video that growth stocks can be much more volatile than the underlying indexes. So when the NASDAQ pulls back and it's about a 4% pullback, growth stocks can correct 2 to 3 times the index. So in that case, growth stocks could pull back 8 to 12%, 2 to 3 times to the 4% in the index. So some of the things that I look at to really evaluate the pullback and what the action is of leaders, I look at individual names about how many distribution days in a 10-day window, how far off their highs are they, what's the pullback like. I want to look at accumulation distribution, and I want to look at the RS line. So here's the chart, and this is just a sampling of some leaders to look at. I started with Pulte Homes, which has only pulled back 6%. So we got 1 distribution day. The accumulation distribution rating is still strong, and it's a low volume pullback so far to the 20-day. And the RS line is at 3 o'clock, which is okay when the indexes are pulling back, but we don't like to see it get to 4 or 5 o'clock. That's a cautionary sign. So I'm not going to go through every single one, but I want you to take a look at this and get a sense of what's going on. You can also look at, you'll notice that the last 4 names, these are new merchandise issues. These are younger companies that can be much, much more volatile than your more established companies. And you can see Duolingo, 17% pullback, ARM, 17.7, very sharp pullback to the pivot of its base. Affirm, 18% pullback, sharp pullback to the 20-day. And then Coin has also been a strong performer. I think it's almost doubled and only given back 23% in context. So you can see the distribution days are not very, very high, even though there were sharp pullbacks. Now, probably the most interesting thing about the entire exercise to me was to look at the weekly charts. When you have a volatile week like this, you want to put it into context. And Bill would always look at weekly charts to say, what is happening on the weekly? And you can see here, almost every one of these says low volume pullback either to the 20-day or a low volume pullback into the 10-week moving average. In some cases, low volume pullbacks into the pivot. The volume has not been high, showing a lot of distribution. Even the sharp pullbacks, some of them got support at the 20-day and didn't even make it to their 10-week moving average. This is very, very constructive still, that we're not seeing institutions running for the exit. Even though it was volatile, and if you weren't positioned with a good average cost, you might have gotten knocked out of some names. But when you look at some weekly charts, and that's what we're going to do next, you'll see that things aren't nearly as noisy as the week felt like. So these weekly charts are very, very helpful to look at. So let's look at a couple stocks from How to Make Money in Stocks. Bill primarily looked at weekly charts, and you'll notice that all the charts in his book, he marks up the 10-week moving average is really important, and he shows you that big winning stocks, typically when they break out of the base on a new bull market, they move up, and then eventually the first and second trips to the 10-week moving average are usually very, very constructive, and they usually are buyable. Usually the first calm pullback into the 10-week moving average is almost a gimme. And you'll notice that's on a lot of Bill's charts. He marks that up because that's a good place to add if you bought maybe on a breakout. So this is way back from 1963 with Xerox. And I also included something from the 90s. This is Dell Computer, 1996. You can see Bill showing a 7-week cup base. Stock moves up, gradually pulls into the 10-week moving average, and he says add off that first bounce. You buy it. Then he says, look, we got tightness. We got another 10-week moving average pullback, also buyable. The later you get in the move, buying off the 10-week is not advised, but the first two tend to be higher odds. So looking at those and putting that lesson from How to Make Money in Stocks into practice, I just pulled up 4 charts. And these are all weekly charts. Same exercise. Here's Palo Alto Networks. Broke out of a base, pulled back for 3 weeks. Complete dry up in volume. This could be a potential add to your position. You can see Uber, very, very strong. We had this major thrust of 1, 2, 3, 4, 5, 6, almost 7 or 8 weeks up. And now we've had a couple of tight weeks. And then we've come down more sharply to this week. But look how the volume is dried up and it's dwarfed by the big blue spikes. So it's not institutional selling. Affirm, very powerful move, almost 100% move. I think it's 80 or 85%. First down week since it's come out of the base, and it's been on a dry up in volume. Constructive. Here's Shopify. Double bottom base, breaks out, comes back to the pivot, gets support at the 10-week line, and you can see the volume is really, really tame. So the weekly charts are important to look at. I've looked at a lot of them, and they all show this similar action to this, which actually potentially could become an add point if you're looking to add to your position. So let's wrap up and take a look at that pullback report card. The whole process here is to look at the pullback and try to determine what's normal and what's abnormal. One of the questions I ask is the market or the leading stocks, are they pulling back gently and crouching before another move higher? Well, this week was definitely not a gentle pullback. It was kind of some shocks to the market. There were a couple of sharp down days. Seems to be stabilizing a little bit the last 2 days, and we avoided a few distribution days. Is the market or the leading stocks dropping sharply like touching a hot stove? Well, we had some drops, but again, when you put it in the context for the week, they look to be low volume pullbacks. We'll have to see how they close the week at the close today. Percent decline from the highs relative to the index. We showed you earlier that most of these stocks are declining in a normal range, but 2 to 3 times the index, and they've all had big, big run-ups. So I would say that the action is normal in the leaders right now. Are the key levels holding? Yeah, a lot of the leaders are still holding, even though it seemed like there was a lot of damage. Some held the 20-day, and many are holding that 10-week moving average, which is very constructive. The 20-day moving average Now, the NASDAQ, as we mentioned, it's a couple of days below the 20. When you get to 3 or more days, that's really potentially a change of trend. So we want to keep an eye on the close today. The power trend is still in action. It doesn't end until the 20-day go closes below the 50. So we'll keep our eye on that. And net new highs. Brett, are we staying above the 50 net new highs? We're just below it, but I really, the bigger issue is we're still seeing net new highs as a positive number. On a pullback and a sharp pullback, that's still really a good sign that underneath the hood, things are holding up. Now, that could change next week, but we'll have to take it day by day. The action of the leading stocks relative to key moving averages, distribution days, and percent decline. That little table that I showed you, spot checking this stuff, I think it looks fairly normal and constructive so far. We'll just have to see how things continue to stabilize. So the quote of the week is, "The measure of intelligence is the ability to change." That's from Albert Einstein. And we all need to be very, very flexible. The market was pretty volatile early in this week. And, we don't want to get locked into a bullish mindset or a bearish mindset. We want to just observe what we're seeing and then act accordingly based on the action being normal action or abnormal action. And you really can only decipher that if you studied a lot about model book stocks and you know what a winner looks like and you can tell what's normal and abnormal. And I try to teach in some of these moments in these videos some of that action. So that's all the time for now. That's the general market update for January 5th, 2024. Look forward to seeing everybody next week.